Hello, my name is Rohit Jain. I'm the founder of Investello.com. Today we are going to talk about how to use Investello to analyze a stock and to find best companies for investment in Indian stock market. I will begin by telling you about our approach to analysis. We present all the data in terms of charts rather than numbers. This is because our brain takes a lot of time to process text while it easily processes images and patterns. It is easier to form a trend in our mind for a stock by looking at these charts. If you want to know about the value of a metric for any year, you can hover upon the chart for that and you shall see the value in the pop-up. I will now share an example about this. As we can see in this graph, when we hover over the graph, we get the value of the matrix. In any chart, you can just hover upon the graph and see the value for that particular metric. For that, if for example, if we hover over the bar graph for 2019 value of revenue, we know that it is rupees 19,963.62 crores. So likewise, we just need to hover over the graph and we would know this value. We have divided the fundamental analysis of a company into these four aspects. Growth analysis, in which we analyze the growth of the company in past few years. Safety analysis, in which we try to understand how safe it would be to invest in this company for a long term. Performance analysis, in which we analyze the performance of the company in past few years by looking at certain performance metrics. Valuation analysis, in which we analyze whether the company is undervalued or overvalued at the current price. We now try to understand these analysis aspects in detail. Growth analysis. This module attempts to answer how has the company grown in terms of revenue, net profit and dividend. Along with that, we also attempt to find the equity dilution so as to determine how much of this growth has actually benefited the retail shareholder. This is because certain companies tend to issue additional shares and thus dilute the ownership of existing shareholders. Thus, even if the company may have grown well, the shareholders of the company may not have realized these gains because of dilution in the shareholdings. We shall explain the impact of equity dilution of shareholders' earnings in the future videos. I will now present the growth analysis of Titan. Let's begin the growth analysis of Titan. First of all, we look at the revenue graph. In 2007, the revenue of Titan was rupees 2090.65 crores. After 13 years, in last 13 years, it has grown by more than 10 times. If we look at the data of the year 2020, it is rupees 21,204.86 crores. So this is more than 10 times of in 13 years. So this is a nice growth. If we compare the EPS and profit, let's look at the EPS because this is the actual earning for shareholders. So EPS for 2007 was 1.12 and EPS for 2020 is 16.91. So while the revenue has grown by only 10 times, the EPS even has grown faster and it has grown by more than 15 times. Let's look at the dividend. Dividend in 2007 was 0.25 and here in 2020 it is rupees 4. So dividend has also grown by more than 15 times. So Titan has shown a really nice growth in last 13 years. And let's now look at the growth, the equity dilution graph. In 2007, the number of shares were 8,877.80 lakh, and in 2020 as well, it is same. Please note that this has been normalized for splits and bonuses. So if the company has actually split the shares or has issued bonuses, this has been adjusted for that so that we get the actual dilution, not the dilution which is not impacting the normal shareholders, just the dilution which is actually impacting. So Titan has not issued even a single share in past 13 years, which has not been distributed to all the shareholders. This is also a good thing. This is a good indicator. And let's look at the growth summary now. Let's look at it from the TTM graph, or we can also look at the annual graph because the 2020 results have been announced. So in past 13 years, as we can see, revenue growth, annualized revenue growth for last 13 years is around 20%, which is a very good growth. And annual growth for net profit is 23.22%, which is even better. But in the longer term, we should look at the revenue growth because profit means when the profit is growing higher than revenue, mostly it involves improving the efficiency, which is good thing, minimizing the cost, etc. But it has a certain limit, means you can't go beyond that limit. So ideally, this is the growth that we should ideally look at when the net profit growth has been higher than revenue. So even this is a very good growth. And when we look at the past 5-year growth, they are more or less similar, revenue growth and EPS growth. When we look at the 3-year growth, then EPS has grown much faster in comparison to revenue. So in past 3 years, Titan has grown really well. Maybe there was some lean patch within this 5-year or 3-year gap, but in past 3 years it has grown well. In past 1 year, the growth has slowed down a bit, but not so much. Means it is still growing, but in past 1 year, it has grown only decently. But past 3 year and past 13-year growths are good. So this is the growth analysis for Titan. Now we come to the safety analysis. Safety analysis is very important for any stock. According to Warren Buffett, there are two rules of investing. One, never lose money. Two, never forget rule number one. With this statement, Warren Buffett intends to tell us that we should lay maximum emphasis on the safety of our investment. Thus, we should never overlook safety red flags such as high debt, pledged shares, etc. in the pursuit of finding growth stories and turnaround stories. The safety analysis module attempts to answer for how safe the investment in this stock would be. In this step, we analyze debt equity ratio, current ratio, income versus operating cash flow, and changes in shareholding pattern. This would help us to identify any red flags associated with the company. Now we shall look at the example of Titan again for the demo of safety analysis. Let's begin the safety analysis of Titan. As we can see, in 2007, debt equity ratio of Titan was 0.73 in 2007. The debt came down steadily and it reached to zero in 2011. So the debt really decreased during this period. And for next 2-3 years, it was stable, and then it increased to 0.32, and then it decreased again, and it has had been zero until last 4-5 years. And recently, in the latest results, the debt equity ratio has increased to 0.35. So this is a sudden increase, and it means that the Titan has taken on debt in recent times. Maybe they have plans to grow their operations, and so it needs to be investigated further that if the company is taking debt, where is it putting the cash obtained from this debt, and how it plans to utilize that in future. So this information can be obtained from annual report, but from this graph we know that the Titan has recently increased its debt. Uh, Regarding the debt equity ratio, usually the debt equity ratio less than 0.5 is considered safe, but I would recommend to prefer the companies which have kept the debt equity ratio below 0.25. Uh, this is a very conservative estimate, and it is not applicable to all the companies. Personally, I prefer this rule to keep it below 0.25, but in exceptional circumstances, we can even allow it to go up to 0.5. But beyond 0.5, I personally consider for long term it is a bit risky approach. But different people have different points of view. I am just recommending from a more conservative perspective because I personally put safety analysis on a higher priority. Current ratio. In current ratio, uh, 2000 in 2007, current ratio was 1.27. It increased and it went up to 1.89 in 2016. And it has maintained a decent current ratio of 1.8 until 2020. As I have mentioned here, a current ratio of 2 is considered ideal, but the companies that have current ratio less than 1 should be avoided. So ideal is 2, but it should be at least 1. So as we can see, Titan has kept the current ratio above 1, so which is a good thing. What is current ratio? Current ratio is current assets divided by current liabilities. So whatever the current assets company has, like cash, receivables, etc., and whatever the current liabilities the company may have, we take a ratio of these. So we know that how much of the current assets are actually enough to meet the current liabilities. So if this is less than 1, it means that the company is facing trouble to meet its current liabilities with its current assets, and it may need to raise money in the near future. So this should be taken up as a good indicator of company's safety metric as well, along with the debt equity ratio. Interest coverage ratio is linked to debt only, but here we are comparing the profitability of the company versus the interest that the company has to pay on its debt. So whereas while the debt equity ratio gives us the ratio of debt versus net worth of the company, interest coverage ratio gives us an idea like how many means how much is the profit of the company and capable to meet the interest obligations of the company. So if it is very low, then the company is in a red zone. So as we can see, in 2007, interest coverage ratio was 6.5. It should ideally be more than 5, and it should definitely be more than 2.5. So uh, it was near that recommended mark of 5 in 2007, and then it increased up to 20, and in 2019 it was at its peak of 38.29. But recently it has fallen because the company has taken on debt, so definitely they would be making interest payments. So that's why interest coverage ratio has decreased. Interest coverage ratio is earnings before interest and tax divided by interest. So if the earnings are decreasing or if the interest are increasing, this ratio will come down and vice versa. So ideally, we should definitely prefer the companies whose current interest coverage ratio is more than 5. Income versus operating cash flow. Now, this is my favorite graph. Uh, Usually what happens is that when the company books a profit, it can include the receivables as well. So a lot of companies, what they do is they can sometimes do some accounting manipulation and show higher earnings, or they are maybe counting receivables which may not actually be realized by them in future. So while the income graph gives us a good perspective that okay how the company is growing, it is the operating cash flow which gives us the actual picture about the cash flow of the company. It is the cash earned by the operations. So this is something which is difficult to manipulate. Ideally, the cash flow should always be higher than the net income. So as we can see here, uh, for the period between 2007 to 2011, it has been more than the operating cash flow has been more than net income, which is a good thing. Between the period of 2012 and 2016, it was less than net income, and between this period, it has been zigzag. And in the latest results, in 2020, the operating cash flow is negative, whereas income is positive. So the company has actually uh, not earned the cash flow from operations. It has actually made means it has been negative. The cash flow has been negative for 2020. So this should be taken up as a bit of a red flag, definitely in my view, that the company's income has been more than cash flow, and we should maybe check the annual report why it is so. So this definitely lets us know about a particular red flag that the company is showing more profits than its operating cash flow. From this operating cash flow, means this is without deducting taxes, interest, etc. So as we can see, it is the formula for calculating operating cash flow is earning before interest and tax plus depreciation, means even the depreciation has not been counted here, and minus changes in working capital, which means whatever the current liabilities the company may have met with its current assets. So maybe that's why the current ratio has gone up a bit as well. Maybe the company has met its current liabilities, but in that case, the current ratio should shoot up, which has not been the case. So it seems that the company has faced certain challenges with its operation in financial year 1920, which should be taken up as a red flag. So this gives us the increasing debt, uh, interest covering coverage ratio coming up to 13.67, and this negative operating cash flow, this diverging operating cash flow is definitely a red flag. Now we are looking at the shareholding pattern. This is the latest shareholding pattern. So promoters hold more than 52% of the company. Institutions hold about 28.8% of the company. So more than 80% of the company is held by promoters and institutional shareholders, and 18% of the company is held by public. Now the more important graph is the quarterly shareholding pattern. This is a premium feature, but for Titan, it is available for free. So we look at the promoter's shareholding. In last 8 quarters, we see whether the promoter has been increasing their stake or whether they have been decreasing their stake. So we see that for Titan, it has been stable. They have neither increased, neither nor decreased. So if the promoter is actually selling their share, then definitely this is a red flag, because usually promoters don't do that unless they have a very good reason to do that. So either they need to raise some funds or whatever. Uh, Promoters sell their shares uh, in the last, means they try to raise, they have a lot of ways to raise money. Promoters decreasing their shareholding in a very significant way is a definite red flag. Also, pledged shares. Pledging the shares is more uh, like mortgaging the shares. You can The promoters can pledge their shares with the custodian and raise some money, and when they pledge the shares, it shows that not everything is well with the company. So again, as I said, this is usually the last resort to raise money. The company can raise the debt on its own. It can issue additional shares to raise money. It can so after the company has exhausted all these measures, usually it is then the company pledges its shares. And so we should look at the companies which have no pledge shares, or at least have less than 5% shares pledged. If it is more, then we should not look at it. And for public, we can also check the public shareholding pattern and institutional shareholding patterns. So we can see that in last quarter, the public shareholding has decreased and institutional shareholding has increased. So likewise, we can get the variation in the shareholding pattern across the last few quarters. So this gives us an idea. So here in this tab, we have checked the safety for this company, which is the most important thing. So by looking at the Titan's safety analysis, the conclusion points are the debt has increased, and the current ratio is below 2, and interest coverage ratio has obviously come down because of the increasing debt. Income versus operating cash flow graph. Operating cash flow is moving below income, which is again a red flag. Promoter shareholding is stable. There are no pledge shares. But overall, looking at the picture, I'm worried about this decreasing cash flow, or decreasing operating cash flow, and this increasing debt. Now we come to performance analysis. In this module, we analyze the past 10-year performance of the company through some metrics such as return on equity, net profit margin, free cash flow, etc. Let's analyze the performance of the Titan with respect to this analysis page. Let's begin with the performance analysis of Titan. In this example, I will cover certain ratios and metrics to cover performance analysis, which are return on equity, net profit margin, net profit versus revenue, and free cash flow. So we begin with return on equity. Return on equity is actually the return on net worth of the company. Suppose the net worth of the company is rupees 100 crores and the net profit is 25 crores. So the return on equity will come out to be 25%. Uh, Through this ratio, we come to know how much return the company is generating over its net worth. So suppose in 2020, the return on equity is 22.51%. This means that the company is generating 22.51% of return in terms of profit over its net worth. So ideally, this should be more than 15%. So let's check for Titan. For Titan, we check that it in 2007 it was around 30%. Went up to 41% in 2011. It came down to 16.81%, and right now it is 22.51%. So return on equity has hovered between 15 to 40%, which is a huge variation, and right now it is near 22.51%, which is quite good. Let's look at the net profit margin. Net profit margin is the ratio of profit versus revenue. That is how much of revenue the company is able to save as profit after meeting all of its expenses. So in 2007, the net profit margin was 4.76%, and it went up to 7.17% in 2013, and right now as well it is around 7% only. So the net profit margin is near to its higher range at this moment. We also check profit versus revenue graph. We can see that revenue and profit, both of these have consistently grown over past 13 years. The growth has been consistent, which is the more important part. Usually a consistent growth comes out of a competence in market, which it displays that the company is a leading player in its domain. That's why it is able to maintain a consistent growth. So a consistent growth in revenue and net profit is a good indicator. Now we come to free cash flow. Free cash flow is the cash left from operations after meeting the capital requirements of the company. The capital requirements include the purchase of plants, equipments, etc., or property which are needed to carry out the operations of the company or grow the operations of the company. So if a company is generating free cash flow, that means that its cash flow operating cash flow is enough to meet its capital needs. So a positive free cash flow and a growing free cash flow is a very good sign. So as we can see in case of Titan, in 2007 the free cash flow was 54.31 crores. It was positive for about 4 years and it went up to rupees 988.14 crores, and then it was negative in a few years as well. In 2014, 2018, 2020, it has been negative. So a negative free cash flow, where while it is not necessarily a bad thing if the company is actually investing for futures growth, like we have seen in case of Titan, it has taken up debt as well. So maybe they are investing a lot for future, or maybe it may be the case as well that their present operating cash flow is not enough to meet the capital needs. So as we checked for 2020, operating cash flow was negative. So if the operating cash flow itself is negative, then the free cash flow has to be negative as well, because from that the company will also be meeting its capital needs as well. So in case of Titan for 2020, negative free cash flow is not a very good sign, I would say. Valuation analysis. It is important to note that the valuation analysis must be performed only for those companies that are found to be satisfactory in terms of safety. If a company has high debt equity ratio, plus shares, etc., such a company should be avoided even if it is found to be undervalued during valuation analysis. The purpose of valuation analysis is to determine whether a company is overvalued or undervalued at the current price. During valuation analysis, we analyze a company from various perspectives before arriving at a conclusion of it being overvalued or undervalued. Now, let's check the four valuation models we use for the valuation analysis. Graham model. This model gives us a static view of the valuation of the company. It does not cover the growth potential aspect of the company and covers only the recent profitability of the company along with its net worth. PE model. This model compares the median historical PE of a stock with its current price. If the current PE is found to be less than median PE, the stock is deemed as undervalued according to this model. DCF model. This model determines the valuation based on the capability of a company to produce the amount of free cash flow. This prediction is made on the basis of past performance in terms of free cash flow. EPS growth model. This model determines the valuation based on the past growth in earnings of a company. Using the past growth in EPS, we estimate the future EPS and thus try to use that during valuation analysis. During valuation analysis, we compare the current price of the stock with the price given by each of these valuation models and thus determine whether the stock is undervalued or overvalued. Let's proceed with the example of valuation analysis of Titan. We now begin with the example of valuation analysis of Titan. The four models which we cover for valuation analysis are PE valuation model, DCF model, EPS growth model, and Graham model. I will cover these models in detail in a future video on valuation analysis. For now, it would be sufficient to understand that these four models give us four different prices as per their formula. Thus, we can compare the current price of the stock with respect to the prices given by these models and analyze whether the stock is overvalued or undervalued. Ideally, we should purchase a stock which is either undervalued or fairly valued. If a company's stock price is less than the price given by the at least two valuation models, we can say that it is fairly valued. Also, we can get a price according to a valuation model only when the past values of the matrix satisfy a particular criteria. For example, in case of Titan, the free cash flow in 2018 was negative. Thus, the DCF valuation model cannot be calculated for this company because it is a condition for the calculation of DCF valuation that during last 5 years, FCF should not be negative for any of the last 5 years. Thus, we have the valuation prices for only three models and not for DCF model in case of Titan. As we can see in case of Titan, all three valuation model prices are less than the current price. So we can conclude in this case that Titan is overvalued at this moment. Using dashboard, we can get a bird's eye view of a company and see the important metrics before delving deeper into the analysis. We can also check the major pros and cons, which can help us with early rejection of a bad company or to determine whether a company is good enough for further analysis. Let's check the dashboard for Titan. The first thing we see on dashboard is the price versus book value graph. For Titan, we can see that its price has grown well over last 13 years from rupees 77 on 1st January 2008 to rupees 997.85 on 16th July 2020, while its book value has increased from rupees 3.82 in 2007 to rupees 75 in 2020. In key metrics section, we see that the current PE ratio is 58.63. We also see that the price to book value ratio is 13.28. In summary at a glance section, we see that the debt equity ratio of Titan is at 0.35 and its growth has also been a bit slow during last 1 year. We also check that we have 3 red dots and 0 green dot in valuation section, which indicates that the company is overvalued. Based on our analysis of Titan so far, we can draw the following points of conclusion. We can conclude that the growth of Titan has slowed down in the latest year. We can also conclude that the quality of earnings has deteriorated because the operating cash flow is much less than the net income in the latest year. In fact, the operating cash flow for the latest year 2020 is negative. Combining these 2 points, we analyze that not only the growth has slowed down in the latest year, but there are chances of growth slowing down even further in the coming days because there is a wide gap between net income and operating cash flow. Furthermore, we see that the debt on the company has increased and the company would need to shell out a part of its operating income to meet increased interest payments, which can lead to further burden on net profitability of the company. In the end, we see that the company is overvalued as per the current earnings itself. Thus, we see that with the help of Investello, we have been able to analyze a lot of aspects about Titan, which shall help us to decide whether it would be good to invest in this company for a long term or not. I hope this video has helped you in understanding the process of analysis of a company before making a decision for long-term investment. If you found this video helpful, please let us know about it in the comment box. We shall post more of such videos to help you make correct decisions in the stock market. If you would like to be notified for our future videos, please subscribe to our YouTube channel as well. Thank you very much. All the best with investing.